Welcome back, ladies and gentlemen. My name is Joshua Castillo. If it's your first time checking out the channel, welcome. I am a value investor here on YouTube. I like looking at companies and I like looking at what other value investors do, as well as teaching you and kind of just showing you what I'm doing here on the channel. So if that's something you're interested in, make sure to like and subscribe down below. But with that being said, as you can see from the title, today we're going to be taking a look at Dropbox and more specifically their Q2 2023 earnings, as well as just updating the valuation of the company. And then if I've made any moves, I'll let you know in the video as well. Stay tuned. I think that this one's a good one. I think this company is a really good company and it's generating a lot of free cash flow. So that's something we love to see here on the channel. With that being said, let's dive right into it. Now, as always, what I've been doing on the last couple of videos is just setting up a PowerPoint and kind of going through it. So I'm just going to follow that same kind of formatting and we'll roll with it. Now, first things first, up is the balance sheet. Q2 2023 ended June 30th, 2023, obviously. Now, it's pretty much relatively flat. Nothing crazy to report. There were some moves as far as cash and cash equivalents as well as short-term investments. But as far as their current assets go, it wasn't a crazy move at all. And a lot of it really has to do with just timing of things and when they recognize different, accruals and different expenses and things like that and how it hits the different accounts. So as far as, movement, nothing really crazy happened. Going down to the liability section, again, nothing really moved. What you like to see is that deferred revenue section growing though. So that's always a good sign. It's basically just the recognized revenue that they'll, essentially occur over the next 12 months and kind of how that all works out as far as their financial statements go. Now, their convertible senior notes, I'll mention that here in a second, but really all you need to know is that the company had a $695.8 million in aggregate principal amount of 0% convertible senior notes due in 2026, and then the other half of that is the $693.3 million in aggregate principal amount of 0% convertible senior notes due in 2028. And if you go on the 10K and the 10Q, you can see a little bit more information on that, but really it's just convertible bonds that they had to get a lot of cash that they needed at the time. Now, moving on to the net income statement, the total revenue was $622.5 million, an increase of 8.7% from the prior year last year. And on a constant currency basis, the year-over-year growth was 11.2%. So again, you're still seeing some hits on the currency side as far as, the dollar versus other currencies like the euro as well as pound. And then you have GAAP net income was $43.2 million as compared to $62 million for the same period last year due to expenses related to reduction in workforce in the second quarter of 2023, such as severance benefits and other related items. Non-GAAP net income was $174 million as compared to $138.1 million for the same period last year. And this is something that you really want to pay attention to. Again, as you kind of see the total OPEX, they did do, when COVID kind of first happened, the year of 2020, they did a round of kind of pre-announced layoffs. They basically said, like, we're going to keep your jobs through 2020, but, come 21, people are going to be laid off. And so they went through that round of layoffs. And now on this round of layoffs, they took a lot more of the workforce, and we'll kind of take a look to it here in a second. Now, the cash flows in the second quarter of 2023 included a $34 million of expenditures related to the reduction in workforce. So other than that, before I jump ahead, you can kind of just see it's steadily going up. The revenue's steadily going up, as well as some of the expenses are steadily going up. A lot of it has to do with their development of their platform, as well as paying people, salaries, because R&D and sales and marketing is not a cheap part of their business, especially the R&D side, because there's a lot of things to pay for, and the payoff could be a long ways away. So you like to see that, but other than that, nothing crazy on their net income statement either. Moving on over the cash flow statements, again, you can kind of see the expenses from the layoffs as well as some of the restructuring that they had on their real estate that they tried to get rid of, since they're taking kind of a virtual first approach to this. They did continue buying stock. So down at the bottom, you can see they're buying back stock. It's not as much as last year, but that's not surprising given kind of where their stock is at price-wise. I think as of today, it's at $26, $27, I believe. But other than that, nothing crazy again on their, cash flow statements. They've been making some moves, as well as just different things that they needed to accrue for compensation, benefits, and other liabilities and things like that. So again, when you're looking at this, I think the biggest thing to note as far as a cash flow statement goes is this bottom line number, the net cash provided by OPEX. or operating activities, the capital expenditures, if they're repurchasing or if they're financing anything, these are kind of the key pieces to me. And then obviously the stock-based compensation. I think that's kind of like a big piece that's happened for a lot of companies recently, is how much they're paying in SBC. Now, this is for the reduction in the workforce. So again, as they announced it in sort of the beginning of the second quarter, the company announced a reduction of its global workforce by approximately 16% to streamline its team structure in support of its long-term growth and profitability objectives. The company estimates it'll incur charges of approximately $40 million, and you can kind of read the rest. But really, you can see down below they broke out where those costs will hit. So again, when you look back at the net income statement, a lot of the things that they're talking about here are included in these numbers for the operating expenses, but these are going to be one-time costs that you'll see flow through, and then next year when we kind of look at this quarter again, you'll probably see a year-over-year change for the positive for the company. Now again, layoffs aren't good, but it seems like a lot of the layoffs was tailored to kind of changing the direction of the company, and similar to what Meta had done this last 12 months too. Now the stock repurchase program, again, this is kind of what you've been seeing from the company. The company is not even a $10 billion company yet. So to be repurchasing, you can see in February 2022, they issued a repurchase agreement of $1.2 billion. And obviously there's no like set timeline. So this could happen over years. It could happen over months. It all depends on what the board of directors and the company ultimately wants. But they actually just recently announced another $1.2 billion authorization. So $3.4 billion, that's about 30% of their current market cap today. And again, they've been buying more or less, $150 to $200 million a quarter. So if they keep that pace up, obviously it's going to push the stock price higher, just because they're taking company stock off the market. But we'll have to see kind of what they end up doing, given that their stock price is a lot higher, this year than it was last year, relatively speaking. But we'll have to see. So I'm excited to see that, but I just wanted to note that because I think it's kind of important to take a look at. Now, as far as their earnings presentation, jumping away from the 10Q and as well as the earning release, but going into their earnings presentation, I feel like a lot of times the 10Q is what the government requires them to give to investors, and then the earnings presentation, the earnings release kind of gives you what the company wants to show you. So sometimes you have to dig past what they actually just want to show you and look at other things. But in this case, these are kind of the important things that they have mentioned, and I think that it's, if you're investing in a company like this, it's important for you as well. So looking at the slide though, left side, the revenue for 2020 was $1.9 billion. Into 2022, it's $2.325 billion, and they're on track, I believe, to go a lot higher than that in this year as well. So their free cash flow, you can see again their target, and you'll see it in the next slides, but their target is $1 billion in 2024. So they're on track, as you can see, $491 million all the way up to $764 million for this year. I think their estimates for the forecast that I've seen is around $850 million for the year. So that'll be interesting to see 2023's end numbers, and then obviously non-GAAP gross margin, just shy of 80% in 2020, and then it got a little bit above that in 2022, and I think it's even higher now. So non-GAAP operating margin, similar thing, slower in 2020 obviously, and then picked back up in the most recent years. So kind of key metrics that they're paying attention to as well. So again, the average revenue, recurring revenue is gone up, as well as the paying users and the ARPU, which is everything that you want to see. And I think that overall, they're kind of quarterly reports and things like that lead to this long-term target of 82% on the non-GAAP gross margin, the $1 billion in free cash flow in 2024, and the non-GAAP operating margin of 30 to 32%. Hopping into the earnings call, again, the quarter has gone up, and kind of I'll pull up the estimates at the end before I do the valuation, just so you can see what the forecasts are. But as far as the earning calls go, this is some of the important things that I pulled out of there. There's obviously a lot more information, but you can kind of see here. He said, first, I'll touch on improved churn with individuals. As we discussed in the past several calls, and as the macro environment has become more challenging, we see an uptick in churn amongst our individual users, notably on mobile plus customers. Some of this was driven by recent mobile operating system changes, which increased transparency around subscriptions, and some was also due to some of the areas of app instability. To address the latter issue, our team team made significant progress in enhancing our tooling and instrumentation to detect and address reliability issues, which help reverse the sequential declines in mobile churn that we'd seen over the prior quarters. We also made some optimizations in our payment processing to make it easier for customers to keep their wallet up to date, which has also drove some of the modest improvements in individuals' churn. I think that that's a really good thing to kind of mention, and it's something, if you look at kind of like all their earnings calls, the churn is one of the most important things as far as a company that has a subscription-based model. It's a recurring revenue model. This churn is one of those important things that you can pay attention to. They don't necessarily quantify it, and I don't think they want to quantify it because it probably would look a lot worse than it actually is as far as a business goes. But it's something that you want to hear kind of the discussions on it. What does the analyst ask? What does the CEO, what does the CFO respond to? And what is the recurring revenue as far as things that they're seeing, and kind of, because the churn will give you an idea of not what's happening just in this quarter, but also what's happening kind of overall in the kind of an arc of the business as you kind of would look at it. And if you have a lot of churn and people are leaving the product, that means that there's something A, wrong with the product, B, wrong with the service, or C, it costs too much and they're going to move to something that costs less. So to see them kind of making up for the churn that they're seeing, and obviously the users have gone up quarter over quarter, so it's not a matter of, them losing customers. It's just a matter of, you might see a slowdown in acquisition of customers. So then next, Sonic Kalar is the analyst asking the question, and Tim Regan is the CFO. So he said, great, thank you, Tim. And then maybe a quick follow-up is just in terms of the macro. I'm curious to see if we have to say relative to Q1, if the macro is fairly consistent, or would you say that there's pockets of incremental improvement or worsening? Just any color that you can provide on kind of how the macro has trended sequentially. Tim says, sure. So as far as what we're seeing today, I'd say the macro trends are roughly consistent with what we've observed over the past couple of quarters. On one hand, we continue to see elevated price sensitivity and downsell pressure from our team's customers, particularly those who have had layoffs themselves, and then Sign and DocSend are also continuing to face macro-related headwinds. On the other hand, we're seeing some positive trends around the individual SKUs, particularly on retention, though our sense is that this is largely due to actions that we have taken as opposed to a change in macro dynamics. And we're also seeing continued improvement in sign-up as trends as a result of our rollout of Google One Tap and other streamlined onboarding processes, where our guidance factors in these latest trends. Now, this is basically it as far as what I've been able to pull from the earnings call. I think that overall, to me, one of the most important things is that I think that the business is going to do well, because the cloud as a whole is something that is going to grow. And so even if the market share of Dropbox doesn't grow, if the pie as a whole grows, their dollar amount and market gets bigger. So that's where I think Dropbox kind of fits. And it's kind of an interesting offering. I feel like Dropbox kind of fits more so for smaller businesses and kind of smaller to medium-sized businesses, or like individuals growing into a small business, rather than something like a Microsoft or AWS offering, where a lot of times it's either too complicated or you don't need all of that. So for some people, Dropbox seems to be worthwhile product. As well as the fact that they're combining a lot of things and bundles and things like that. So if you work with a lot of brands or work with a lot of companies that require signatures, you have HelloSign, which is now called Dropbox I, and kind of using that and a lot of the other services that they have bundled together helps out a lot for running your business as a small owner. And now, before I go to the valuation piece of all this, I just wanted to show you what we're seeing here on the kind of what's happening on both the last 12 months as well as what's happening on the estimate side of the business. So I just want to show you the free cash flow real quick for the last 12 months. So we're seeing right now they're at $750 million on the free cash flow side, 30% margin, and you can see it's kind of gone up over the last couple of years, which is to be expected given they're not spending a ton on CapEx right now. So that'll be interesting to see. But the other thing I wanted to mention is the estimates, and I'm on ticker.com in case you've never seen this website before. But what I kind of wanted to mention was you can see the growth in the last couple of years has been more or less closer to 10%, but they're actually estimating a slowdown. So this year is estimated to be 7.2%, and then in 2024 they're estimating 4.4% growth. So a slowdown in growth is not a great thing, but again, you're not paying, as far as a multiple goes, a lot for this company. So I'll show you that here in a second. But I just wanted to show you, so the free cash flow is estimated for 24 to be 960 million. Let's call it 960 million. So I just want to show you this real quick, kind of what this looks like. So I pull out a calculator and basically what you can see for 2024. So you have a $10 billion, market cap as of today. Divide that by a $960 million free cash flow, because that's kind of what it is down here, more or less. And right now you're selling in 2024 a pretty much 10.5 price to free cash flow, multiple, which is crazy. So to me, and this is kind of what I've said too, to me, if you're wrong, the odds of you losing money is probably much lower than other companies. That's kind of why I like this risk to reward of this company. And again, the upside's not fantastic, but if you take something like having $1 billion, so let's say a 960, and instead of a 10, multiple, let's say they actually hit all their expectations and what they're trying. Let's say instead of a 10 multiple, you do a 15 instead. So 960 million times 15, you're gonna have a $14 billion company, which from today's price, it's more or less, I think it's, let's see what it's at. I think as of making this video, it's the 29th of August. So as of making this video, the market cap is 9.6. So rather than doing 10 billion, let's do 9.6, so 9616. I mean, that's a pretty big increase, a 50% increase for holding it basically through the rest of this year into next year. I think this company probably would sell closer to a 15 multiple. And if you look at, let's take a look at the valuations real quick. So the valuations, levered free cash flow yield, it's been selling at about 10% this entire time. Their, net market cap, or next 12-month market cap to the free cash flow is more or less sort of the same deal. So if you expand on this, so the left side is pretty much today, you're at 10. Look at what has happened over the last couple of quarters. So this is back in 2018. This thing was selling at 25, 30. And again, I think the growth expectations is partly why it was selling like that. But ever since, the free cash flow has just continued going up, and this multiple has continued going down, 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 and down, and down. And the mean on this chart is 15. So even if it just sells at a 15, that's a great, upside potential. So that's partly why, and that's mostly why actually, I have this in my portfolio, is I like the risk to reward profile. I like the management team. I like what they're doing. So kind of jumping back over to the presentation and jumping over to the estimate of what I think it's worth. So I took all the numbers for the last quarter, the last 12 months is basically what we're looking at. So current outstanding shares, and again, if the growth in the revenue doesn't really go anywhere, the profit margin and the free cash flow margin stay the same, let's just say it continues generating $2.5 billion worth of revenue a year, you're still going to make a lot of money because they're buying back a ton of shares. So the thing is, current shares, revenue, free cash flow, net income, all that good stuff. That's what I've plugged in here. I have the revenue growing on the low end 5%, high end 10%. I think it's probably somewhere in between the low and the mid case. So the way I look at it, this is the worst case scenario, this is the best case scenario, or this is the base case scenario and the best case scenario. So profit margin of 12%, free cash flow margin of 15%. It's not really below that. I mean, the net income margin and the free cash flow margin haven't really gone that low. So to have it, be that low is definitely worst case scenario. Probably the growth would probably go closer to 0%. But point being is this is pretty low to begin with. So base case being 7%, profit margin being 15, free cash flow being 17, and then a multiple of 20. So with all that being said, the average, across the probabilities and all that stuff, I have the fair value calculated about 24. Now, I hold this company at below $23, so that's why I'm not really worried about it. But for me personally, it's one of those things where this company, if it hits its mark and it's worth a 15 multiple, it's going to be a $15 billion company. So the current market cap being $9.5 billion pretty much gives me a little bit more safety in the fact that, the downside, let's assume this is right. The downside being $17. This thing hit 18 not that long ago, a couple months ago. So it's not impossible. It's not out of the realm of possibility. But if they continue on the track that they're on and the free cash flow does what they're saying it's going to do, and the multiple ends up being 15 instead of 10, you have a company that's worth $15 billion. If it hits 10, it's worth $10 billion. I mean, it's one of those things where they just need to hit their mark. So this is definitely something I'm going to be tracking, something I'm excited for. If you're interested in looking at companies like this, make sure to subscribe. I hope that this kind of gives you a better overview of what happened on the quarter. Overall, not a crazy exciting quarter. Nothing really happened beyond the layoff. So I'll keep you updated as I hear more, as I see more. I'm curious to see in this environment how this company does and how it continues to fare. It seems like overall nothing has really changed. But again, as people start to renew, as you start seeing budgets getting built out for 2024, we'll have to keep paying attention to this company and seeing what happens because, again, a lot of the kind of thesis for this company as far as a catalyst is hitting that margin and making sure that they hit that $950 million goal next year. So I'm curious to see where this ends up going. And again, the valuation, this is more of a kind of realm of possibility, not like if it goes below 23, it's the only way that'll pay for this company. Because I understand that these numbers, these estimations, everything's going to be wrong by next quarter. So I don't base my whole life off of this. It's just, am I in the same ballpark as this company? And, just doing some quick math helps give me an idea of where I am at. But if that's something you're interested in, hit the like and subscribe. Thank you guys for watching. Hope you have a great day and happy investing.